Today, we are talking about two big retirement planning trends that died this year. If you're retired or you're planning on retirement, you are not going to want to miss this one. All that and more on today's episode of The Retire Once Show. Hello and welcome to The Retire Once Show, the show designed to help you get to retirement, but most importantly, stay retired. I'm your host, Johnathan Rankin. I am the founder and CEO of Theorem Wealth Management, and I am joined, as always, by my lovely co-host.
Hi, I'm Melissa Rankin. Thank you so much for joining us.
We are happy that you are here. I hope everybody had a great Halloween. I mean, we did, definitely.
We did. We got a full picture of exactly what it means to trick or treat with little kids who do not know when they're actually tired and should stop eating candy.
But
so that was interesting.
On the positive side, we have a ton of candy that we get to eat.
Yeah, I mean, I don't know. I think they may have ruined candy for me.
Yeah, that may be true, but we're not here to talk about Halloween. We are here to talk about retirement trends that died this year. But before we get into that, what do we want people to do, Mel?
We want you to subscribe. We never want you to miss an episode.
Not at all. Don't miss an episode, whether you're listening to us on Apple, Spotify, or you're watching us on YouTube. Hit that subscribe button. Join this retirement community we are building. So let's dive right in.
So with that, let's start with the first retirement trend that died in 2022. Investing without managing risk. What do you mean by that?
When we think about investing over the past couple of years, it's been a lot different than what we've seen this year, obviously. We were in a long, extended bull market since 2009, and it seemed like every time there was any risk in the market, the Fed was there to bail us out. I mean, you think about end of 2018, market fell by almost 20%, and the Fed came and bailed us out.
The White Knight.
The White Knight, 2020. Once again, obviously we had the correction with the pandemic, brief recession there. And what did the Fed do?
Swooped in.
White Knighted it. So we've had this long period where risk assets were doing extremely well. And, it makes it hard to realize that you got to plan for risk at some point.
Absolutely. I mean, it makes sense. When the market gets hot, I feel like everybody, young, old, retiring, not, whatever, everybody gets the fear of missing out. I mean, that's the whole reason that acronym was created, whatever it is.
FOMO.
Is that what they call it?
Yeah, that is what they call it.
That's how young I am. If people feel like they aren't performing in line with the market, then they feel like they're underperforming. So, of course, nobody wants to miss out on anything.
No, and when you look at the S&P 500, a lot of investors will use that as their benchmark. They'll say, well, if I'm not performing up to the S&P 500, I'm underperforming. Well, if you're retired in a balanced portfolio, why are you comparing your performance to an all-stock index? I mean, the S&P 500, it's 500 stocks. The reality is your portfolio probably looks a lot different than that. I kind of equate it to, if you looked at Tom Brady running today, you can't compare Tom Brady in his 40s doing a 40 time against some rookie running back right out of college. They're in different positions, decades of age apart. They're just in different places in life.
Yes, he's going through a lot of personal stuff.
That is true. You're absolutely right about that. So yeah, he's not going to run as fast as someone that's fresh out of college. Just like if you're retired and you're investing in a balanced portfolio, in a good market, your portfolios shouldn't be at the same rate of return as the S&P or the NASDAQ. You're comparing apples and oranges. Here's a perfect example of what I mean. Now, if you look at this chart shows Cathie Wood's ARK Innovation ETF. This is one of the most popular ETFs over the pandemic investing period. From 2020, the inflows into this fund were tremendous. And we're comparing that to Warren Buffett's Berkshire Hathaway. So from the beginning of 2020 through the middle of 2021, of course, you would most likely want the performance of that ARK Innovation ETF. I mean, you would have been up 145%. Berkshire Hathaway, you're up 21%. You're still positive, but you look at that and you go, why would I ever invest in Warren Buffett's company?
Well, I think that it's because most investors say that they want the type of ride that Berkshire had. I mean, when they see things like ARK, it gets hard to maintain that investment discipline. I mean, overall.
It does. And then when you fast forward to looking at the performance as of today, you look at that and you go, well, Berkshire is outperforming ARK by 50%. if you would have invested in Berkshire Hathaway from January 1st, 2020 through today, you would be up over 31%. However, if you invested in ARK, you would have rode that roller coaster up, put your hands in the air at the top, and rode that bad boy all the way down.
Screaming all the way down, I'm sure. Just like a true roller coaster.
That's right. So that makes it very difficult as someone who's retired to maintain that discipline, because it is hard when you see different investments doing that. And most people don't understand or really even know what it's like to put together an asset allocation, because go back for the past 13 years, bond rates were near zero or around 1 or 2%. So you weren't getting anything investing in bonds.
Nothing to write home about.
Yeah, you weren't getting. There was no income there. So to get any income or growth, you have to expand your asset allocation to a level of 60, 70% in stocks. So you were taking on more risk, and I don't think most people understand what their true risk tolerance is. You only find that out during markets like this.
Which is a good point. So what are some things that you want to avoid in, any given market cycle?
So I think in any market cycle, whether it's a bull market or bear market, you don't want to be too concentrated. You don't want to be too concentrated in the holdings that you've got, or even in the type of investments. In a bull market, you don't want to be too concentrated in just a few investments in the stock market, and you don't want to be overly concentrated in the stock market in general. Same thing with a bear market. You don't want to be over allocated to cash. Yeah, having cash on the sidelines is great, but at some point, we always say on this channel, the market's going to be higher than where it is today. When is that going to happen, Mel?
Gosh, I wish I had my crystal ball ready. I mean,
right. We don't know. We can shake the that magic 8 ball and ask that, and maybe that
outlook not so good.
That's right. I believe that most people are not truly diversified, even when they think they are. And that's because nobody likes seeing things in their portfolio they hate. And if you love everything in your portfolio at any time, you're not well diversified.
Because you love everything.
Because you love everything. That means everything's doing well. There's going to be periods where you want certain asset classes to do well, and other ones aren't going to do so well at that time frame. And that's when you rebalance and you buy the ones that weren't doing well, and you sell off some of the ones that were. And that's creating that automatic rebalancing that you could do over time. But if you love or hate all of your portfolio at the same time, you are not diversified.
So what else can people do?
Well, one thing they can do is they can avoid investing with emotions. And that's to be said in up markets and down markets. It's okay to shift your asset allocation slightly, and you can overweight and underweight different asset classes, but dramatic swings in your asset allocation, if you go from 40% stocks to 80% or 90 or even 100, those dramatic swings are typically led by emotion. They're not led by any sort of logic. It's usually, I don't want to miss out on what's going on, or
Enter FOMO,
or right now, I just don't want to lose. This is kind of that fear of running out. So I don't want to have my retirement assets go to zero. FORO. There you go. I like that. Yeah, we don't want either the FOMO or the FORO to take hold. So those are two things that I would say avoid in any market cycle. Our team can actually help walk you through that. So there's a link in the description below where you can actually plug in your own numbers and see how funded you are to your retirement. And that's going to be based on today's market. You can put in what the value of your assets are today, and it's going to show you how funded you are. But then after that, we're going to spend some time and we're going to help you understand your true risk tolerance, help you build that asset allocation that fits your specific goals. There's not a one-size-fits-all when it comes to investing for retirement.
Unfortunately, that's true. Now that we've gone over what the first trend is that died in 2022, let's talk about the second one, the 4% rule.
Yeah, I've seen this on headlines all over the place. The 4% rule is dead. You got to rethink the 4% rule. There's so much going on right now. I think any time that the market goes through periods like this, people always start questioning these old school thought processes of investing.
Before we debunk it a little too much, I just want to refresh on what the 4% rule is. It's where you should withdraw 4% from your portfolio. Next year, do it again, plus adjust for inflation. David Blanchett, the head of retirement research at PGIM, he actually says that it's really difficult to put into words how awful this year has been. If a client walks into your office, you can't just say 4%. You shouldn't anyway, but you can, I guess.
Yeah, you never just, if someone walked into our doors and we just said 4% for you, for you, for you, we should
just put a sign on the door. 4%.
4%. Hello.
You're welcome.
Welcome to 4% wealth management. No, there is, it is a very challenging time. You've got portfolios dropping, and you look at the 60-40 portfolio, that famous, retirement portfolio, that balanced portfolio, as of October 31st, was down 17.9%, which is one of the worst years it's had on record. And guess what? We still have 2 months to go.
Yeah.
So we don't know, who knows if it gets any better than that. And then you got the other side of it. So you're taking out 4%, if that's what you're following, and that's based on your portfolio value, but then you're also adjusting for inflation. So now you've got portfolio values down, inflation higher, and if you lived by that rule, now you're having to take out a much bigger chunk than just 4%.
The whole thing's already out of whack.
It is, on depressed asset values. I like that. Out of whack. She puts it the right way. When you look at the actual origin of this, that 4% rule, so it was William Bengen that came up with this. He was the author that came up with the concept back in the 90s. He said in that paper, it is appropriate to advise the client to accept a stock allocation as close to 75% as possible, and in no cases less than 50%. But the reality is that was in the 90s. Stocks were doing fantastic in the 90s when he wrote this. In today's market, as I mentioned, the 60-40 portfolio is just getting blown up this year. That 4% rule just no longer applies.
What are people suggesting then?
Well, Morningstar did a study that found a safe withdrawal rate to be 3.3%. And that's really what people want to know. They want to know, how much can I withdraw every year without running out of money? So they found 3.3%. And then Schwab actually did a recent similar study that showed the safe withdrawal as a range. And they looked at that range from 3.4% to 4.1%. They based that range on the confidence level and your asset allocation. So we'll look at the asset allocation part of it first. And you see in this chart shows what a sustainable withdrawal rate would be for a given portfolio. Now, they're starting with $1 million, and they're having retirement lasting 30 years. And withdrawals, obviously, they have to grow by inflation at a constant 2.47%. And this shows the best 10% and the worst 10% outcomes. And as you can see, if you were in a moderate portfolio, they're showing a 4.1% sustainable withdrawal rate adjusted for that inflation. And yeah, there are going to be times, because this is at a 75% confidence level, that there's 25% of the times you're not going to have any money left over, but 75% of the time, and at the most, you can have over $3 million left over. So
that sounds a lot better.
It does sound a lot better. Now let's look at the confidence level side of it. The confidence level, this is the number of times the portfolio ended with a balance greater than zero.
So let me think about it this way. Are you saying that a 90% confidence level, if you looked at 1,000 scenarios using varying returns for stocks and bonds, that 900 of the hypothetical portfolios would have money left?
That's right. Anywhere between 1 cent and a lot more than what you initially invested. This isn't
hopefully a lot more than 1 cent.
But it's giving you that, if you have any money left over in that 90%, that you want that confidence where you didn't run out. Now, I would imagine that if somebody had $10 left in their account, they're going to feel like they ran out. But it is showing that you were positive. You didn't have that worry of running out. Now, as you can see in this chart, you want to base your withdrawal rate on your time horizon, asset allocation, and your target confidence level. And so what this looks at is if you want a 90% confidence level and you expect that your retirement is going to last 30 years, and you're a moderate investor, that means that your target withdrawal rate would be 3.4% to create that long-term sustainability. However, if you felt like retirement's only going to last 10 years, which hopefully it lasts a little longer for most people, but if that was your time horizon and you invested conservatively, you could take out 9.6% per year. And it really ranges between how long you're going to need the money for, how confident you want to be, and what that asset allocation is.
If the 4% rule is actually dead, then what is the safe withdrawal rate?
Well, as we talked about before, there is no one size fits all. There's not.
That's where we get the range?
Yeah, that's where not everybody's walking into the office saying 4% for you and for you and for you, and everybody gets. We are not Oprah giving out withdrawal rates.
New car for you, new car for you.
It is. The 4% rule is supposed to be a guideline. This is not a retirement plan. And that's, I think, what they took it a little too far. They thought, well, I'll just live off the 4% rule. And I don't have to do any retirement planning. I take 4%, very simple. People like simplicity until a year like this year.
Until it doesn't work for you.
Yeah, that's the problem, is that, the 4% rule does apply as a general rule of thumb and a guideline, but people are learning the hard way this year. They're learning that there's more to retirement plan than just rules of thumb. And, what we believe in is you've got to put together that detailed retirement plan that is based on you, your goals, your life, everything about you that's personal to you. It's not about what is good for the general populace. It's what's good for you. And update that plan consistently. That's what we believe in. So start with that link. That's where you can see where you stand today based on your goals and what's going on in the market today. And then we're going to set up some time where we can start building out your specific retirement plan, your target asset allocation, help you understand your risk tolerance, and base everything on your specific retirement. So with that, before we get out of here, what do we want people to do, Mel?
We want you to subscribe. We want you to come along every single episode. We never want you to miss one.
And I promise you, if it's anybody reaching out to you after you fill that out, it'll be Melissa, because I know most people want to talk to her as opposed to me. So
I'm at least funnier. I mean,
Oh, that's debatable. But with that, I am Johnathan Rankin.
And I'm Melissa Rankin. Thank you so much for joining us.